Okay. All right. It's the show on the road. And everybody, thanks for joining us today. My name is Erin O'Neill. I am your community guru in the RevOps Co-op. You have found your way to a roundtable with Captivate IQ. Today you will hear from panelists in a roundtable format on the subject of recession-proofing your comp plans, which is quite timely. During the discussion, feel free to post your thoughts, me too's, great ideas, and questions right there in the chat. You can also drop questions in the Q&A section, and they will also show up in the chat. If you do it that way, they'll just be less likely to get lost in the thread. We will answer some questions during our talk as we find space, and then we'll save some time at the end of the event to answer any final questions anybody has. Also, this event will be recorded and posted to our website for you to review and share at will for all time, or until something crazy happens. I also wanted to give our partnership program a quick plug because we've recently supercharged it. We've been adding a lot of new partners to the community, one of them being Captivate IQ. We do partner with like-minded companies that want to advance the RevOps industry. Not only are their products and services useful to GTM teams, but we see them as an extension of our community team by hosting events like this one that are valuable to all. And they also help members in our Slack instance with their experience in their areas of expertise. So get to know these guys today. Some of them are helping out with the event, but everybody is a well-known person in the community. They're here to help, so please do reach out to them. And with that, why don't you guys introduce yourselves?
Sure, I'll kick things off. I'll be the host and helping to moderate today's discussion. So my name is Mark Schottmeyer, co-founder and co-CEO of Captivate IQ.
I can go next here. Christian Borelli, also at Captivate IQ. I lead the sales org here. Been on the team for the last 4 years or so. In prior life, have written many comp plans, more than I'd like to admit, I guess, for all different types of companies, industries, sizes, venture-backed companies, private equity-owned companies, public companies, all kinds of stuff. So hoping to help answer a lot of questions today, but also anybody has any burning comp-related questions, you can always find me on LinkedIn. Happy to nerd out on that kind of stuff.
Hey everyone, Rome Thorndike. I lead sales over at DataJoy. Before that, I was at a Series D startup, and before that, in sales at Salesforce and Microsoft. So, done it with pretty big, well-known companies as well as seed-stage companies like where I am today. And thank you for having me.
I'll go next. Hey everyone, Chris Pitchford, VP of Sales at Ally.io, which is now Viva Goals within Microsoft. Happy to be here. Looking forward to the discussion.
Name is Jeff Ignacio. I'm our head of sales ops at Forethought.ai. Prior to coming here, I've been at large companies like Intel and Google, AWS, and a bunch of startups, leading sales operations, designing comp plans for all segments and global sales teams. Thanks for having me.
Also, Jeff, don't you dare forget to mention that we partner with you on an Unleashing ROI course. That is, it's cohort, it's quarterly. We're about to launch our next cohort in July. So thank you for that.
Yeah, ROI stands for RevOps Impact, not return on investment, but I think they're the same thing.
Well, Aaron, with that said, let me know if you want me to take it from here.
Oh, yep. Go ahead and take it from here, Mark. It's all yours.
Awesome. Well, thank you. And again, welcome everyone to today's conversation. Maybe to kick things off, over the last several months, we've seen significant adverse changes to the public markets in response to rising inflation and interest rates. And this is further exacerbated by the war in Ukraine and supply chain issues that continue to hit several industries across the board. As Aaron mentioned, we brought together a collection of leaders for a conversation around to share perspectives actually on how they're responding to these changes as it relates to their go-to-market organizations, but also sales compensation strategies. The spirit of today is to have candid conversations, and that includes having conversations also come from the audience. So maybe a quick agenda. We'll spend probably a good from 10:07 all the way to 10:45, just going through a series of topics and questions and conversations. 10:45 to 10:55, would love to be able to open it up to Q&A from the audience, and then we'll wrap up over the last 5 minutes. So if you have questions, please feel free to drop it into the chat. And I think how we'd like to be able to run things today, if there are questions as it relates to certain topics that we're talking about, we love to be able to pull those from the chat. Otherwise, we'll try to cycle through the most pressing questions towards the end. So with that said, jumping right into the thick of it, we've seen tech layoffs dominate the news over the last several weeks. I'll avoid naming them, but you can go to layoffs FYI to see some of the latest and greatest, as well as companies cutting back on hiring, Coinbase, Meta, SFTC in particular, but definitely not limited to those folks. Kind of a loaded question, but just a question to everyone here. I think it'd be great just to hear a perspective from everyone in the room. How has your business and teams been impacted by recent dynamics? So maybe to kick things off, I'll just pick someone at random, but Rome, do you want to kick it off first?
Yeah, sure. I'd say that the recent announcements haven't really impacted us. What impacted us was in November when we saw that tech was rolling over while the general market was doing quite well. We were a little paranoid when ARK topped in February 2021. They, as you know, invest heavily in small cap tech. That's what we're in. And the optimists in us, it's hard being in this business if you're not an optimist, saw that infrastructure still doing well, which is what we do. We're a Snowflake partner. So all of that doubt was erased once we saw that collapse in November, and we started making some decisions then in terms of being more selective in our hiring process, bringing contracts and renewals forward. So I'd say, if anything, over the last month, I'm seeing some encouraging signs. I could get into that later, but we've been pretty paranoid about this since November, and we've reacted accordingly.
Very cool. Christian, what about you? What are you seeing on the Captivate IQ side?
Yeah, I feel like this is kind of a test, Mark. I think where we came into this year, coming out of the almost say irrational exuberance of the last 2 years or so since a couple months after COVID, we had kind of aggressive growth plans, wanted to really invest in expansion, that kind of stuff, and kind of just did monthly check-ins to see what we were seeing in the market, what other companies were doing. Obviously, the feedback we were getting from the investment community on how they're thinking about how companies should be planning, and kind of out of abundance of caution, adjusted hiring plans, adjusted kind of our expectations for the year, the expectations that we're setting for ourselves and with our investors, to make sure that we're in a healthy spot and really protecting everybody on the team. So we haven't seen much of a kind of massive hit to demand or anything, but going into an environment that's very different from 9 months ago, where companies were raising capital every 6 to 12 months, knowing that that's going to be different going forward. Just wanted to kind of right size our plan to make sure that we're in the best possible position going forward for the next couple of years.
So I can agree with understanding what's going on there. Pass it to Chris. Especially you're also, as you mentioned, being a part of a bigger company. Also curious to see how that also extends to the mothership at Microsoft.
Yeah. It would be good to almost understand from the audience if they're sort of in early stage tech or growth stage tech, or if they work for public SaaS companies. I'm assuming most people are in technology, so feel free to use the chat if you want. I guess the way that I look at it, Mark, is, essentially just zooming out for a moment, stocks evaluations are getting hurt by these rising interest rates. Growth company stocks that have their earnings like in the distant future, which is, a lot of us on this call, they're getting hurt the most. And when you look at like the public company, like there's the SaaS index, those companies during the pandemic really skyrocketed all the way up to 35x multipliers they were getting on their revenue. And if you look now at the average these companies are getting on average 5 to 7x multipliers. So, even for private startups, I was seeing rounds that were happening at 100x ARR, right? And so those days are kind of gone. And this really trickles down into the private markets. If those are valuations at 5 to 7x ARR for public companies, then Series D, E, F rounds, growth rounds are going to get impacted. And that means early stage seed rounds or Series A, early stage rounds are going to get impacted because of those downstream rounds. So I think to answer the question, it's a spectrum of maturity of the company. Early stage companies are going to have to be extremely focused on sales and marketing spend. If it doesn't directly correlate to ROI, like there's risk that it's going to get cut at this time. Whereas if you look at large organizations like, Microsoft, others, of course, they're naturally more diversified. So they can be in a slightly different position, maybe to invest in their employee base. They'll also have to tighten the belt. But just because of the diversification of their business being in so many different segments, verticals, it allows them to be a little bit more flexible during this time. So that's sort of my sentiment right now, Mark. And I think it's a great question to sort of get this conversation going.
100%. And it's very, you mentioned something about the 100x ARR, and very timely. One of the leading investors out there, Redpoint, came out with just probably the worst timed article of, I'll paraphrase from this article. Regardless, the 100x ARR multiple seems to be the benchmark of the industry today. That was November 2021, literally at the start of the adjustments that you're seeing out there. But I'm curious, they haven't retracted it, so maybe they're standing their ground. So if you guys are looking for capital, maybe they're the ones to hit up. But Jeff, taking it away, maybe the final perspective on this.
Yeah, I have to agree with, we take our signal from the public markets, right? The cost of capital is up. So growth in the outlying years is being punished. So those in the SaaS business where you're looking to have profitability in your outlying years, it's a tough slog. What we're seeing are signals from our investors to extend their cash runway, just because we don't know what the fundraising environment is going to be, nor what the new reward metrics are going to look like. So if you have 2x growth, year-over-year growth, but you still have pretty decent margins, those are the things we want to make sure that we prepare for. So have some scenarios on the downside, have some scenarios that where your best case, and then where you're likely to land. We're also seeing some green shoots in our pipeline as well, right? So customers are starting to tell sellers that they're pausing those nice to have purchases and really looking for those need to haves. So really sharpening the pencil on who you're selling to. So what are your ICPs? What are your core segments? Some of those ancillary products or experiments that you were thinking of launching, those may have to be put on pause. So really taking a look at what makes the most sense in this type of operating environment. Second is those, really tightening up the operation of the business. So coming from a RevOps role, I'm overthinking how do we over communicate with the leadership team on what's happening in the pipeline? How do we hold ourselves accountable to performance? And some of those things could be as simple as tightening up our forecast cadence. So moving from either a quarterly to a monthly or monthly to a weekly, maybe even putting in daily huddles to see what's happening with some of those second and tertiary ICPs. Re-examining marketing spend, so doubling down on the campaigns that are still working and cutting and trimming those that are underperformers. Keyword tracking, taking a look and seeing if our competitors are actually stopped spending, and some of the keywords that are our top performers are those is the average spend going down in those areas. So could be an opportunity for us to be opportunistic and double down. Second is that that qualification criteria. If you run an SDR team, are you really focusing on what would be your best prospects, your best customers? And then lastly, if you are hiring, this is a great time to scoop up some great talent because firms are letting some folks go. So we're really sharpening a pencil on what's your hiring criteria, and again, being opportunistic about it.
A lot of good ideas, and we're going to jump into a lot of those in some of the following topics. Maybe, from what I've seen from just from the investment community, as some have echoed, we've seen a lot of noise, a lot of conversations, a lot of points of view, including how long this will last. I've seen as short as 12 months. I've seen as long as 4 years. I think maybe just to help kind of set the tone and case for some of the following questions, we'd love to be able to run through all of our speakers today just to give a quick answer around how long do you think this will last, so that we can kind of at least get a point of view of how these strategies need to permeate from it. So maybe starting with you, Rome, how long do you think this will last going through the downturn before we start seeing a recovery?
I think it's really hard projecting anything after a year. I don't think many people thought that Ukraine would have been invaded in the beginning of last year. That's generally how we look at our business. And we talked about comps. We look at that compared to the general market in terms of dictating us. I think the bond market can be helpful too. Stanley Druckenmiller was interviewed by John Collison recently about that and said, look, now that the Fed is pouring money into that environment, you can get some strong signals from them. And they're generally a year or two out. So if you see yields collapsing, you know that there's a larger slowdown on the horizon. So that's what I'll keep my eye on. But here at DataJoy, we look a year out.
How about you, Christian?
Well, Chris and I were disagreeing on this the other day because I thought it was going to be, 3-4 years. I think it could be on the shorter end of that, maybe 2-3 years. But it all comes down to, you have Jerome Powell saying a couple days ago that he's, basically fully prepared to bring on a recession to curb inflation. I will say though, outside of, energy costs, it does seem like consumer spending is going to curb pretty quickly. So maybe we see that get reined in, and it is, maybe only 18-24 months. But I don't think this is a, quick checkmark shaped recovery like what we saw after COVID.
Good perspective, and a lot of you're right. There's a lot of you're seeing a lot of Fed signals on how they might be thinking about it as well, which is kind of making it more complicated. Chris, what about you?
I kind of agree with Rome here. It's really, really hard to predict. If you do a quick Google search, average length of recession since 1900, the average length of recession is about 15 months. I'm typically optimistic. I'm bullish. I'm glass half full. I like to bring that optimism into my life. So I'm modeling on 18 to 24 months. But just because it hasn't happened doesn't mean it can't. So, I think it's a good conversation. I don't know is really the truth though.
For sure. And Jeff, how about you?
Yeah, I studied economics in undergrad. Doesn't make me an economics expert. But I would say we're planning for 2 years, right? So we were in a fortunate position of raising funds before the bell tolled, so to speak. But we're preparing for 2 years, right? So if the average recession is 15 months, we want to be better. We want to have at least runway beyond that. So 24 months is kind of the recommendation. So not everyone's going to be in that same position. So you may have to, make some hard choices from now until then. But yeah, who knows? Some of the underlying pinnings on the supply side of the equation for inflation don't seem like they're going to be unwound very quickly.
For sure. And I think, one thing that we're hearing across the board, and hopefully for the audience that you're picking up, I've certainly got some flashbacks to macro econ in college, which is putting it's a date on me. It's a long time ago. But, it kind of leads into the next question that I'll jump into a second. But I think one thing that's important to call out that we're seeing across the board from all the feedback is that this is probably the first time in a long time, a couple decades maybe, or at least going back to the early around the 90s, government is not on the side of business. I think that's an important distinction. The investor kind of gave that perspective, and I thought it was actually a very keen insight. For the last couple downturns, we've always had government on the side of business through TARP, through lowering the interest rates, et cetera. Right now, there's actually a conflict of interest, as has been pointed out. The Fed's trying to curb inflation, and so they're actually trying to destroy demand. So depends on how, when you think they've succeeded in that job is probably how long this will draw out. Kind of leading to the next question before we get into the meat and potatoes of the sales commission stuff. Leading market signals. I'm sure a lot of people on this call are also trying to figure out how to navigate their own respective leadership teams and thinking about how to adjust their plans, especially if we go into the back half of this year. Open up to the group. I don't think we need to go through around the horn, but what leading market signals would you look for to say that we've gone through the thick of it and we're now in more of the recovery period, and we can start to open up budgets, we can start to think about being a little bit more aggressive, et cetera?
Well, I'll talk about how my last company, SnapDocs, addressed this. So we're in digital mortgage closings, and I remember when Bill Ackman was on TV pounding the table saying hell is coming. And had we just listened to him, and he knows a lot about the business environment, we would have let go of a lot of people. But instead, what we did was just look at the signals. And what we saw was that DocuSign, who was one of our greatest partners, was doing really well. So why are they doing this when the rest of the market is doing that? Well, if you imagine people are worried about meeting in person for signing for stuff, it makes sense that DocuSign might do well. And for us, how do you buy your home? How do you sign title documents if you can't meet in person? You probably need something like what our company did. So we did not let anybody go. In fact, we did the opposite. We zigged when a lot of people zagged, and it put us in a great position to capture market share. Airbnb, on the other hand, they did have layoffs, and as unfortunate as that is, it was sensible, right? They're in the travel industry, and it was effectively frozen. So I would look at your comps in the publicly traded market. How are they doing compared to the rest of the market? And if you're outperforming, it may just be that you're in a really, really good position to seize market share. I would not listen to what the media is saying. You were just saying, Mark, that Redpoint called the top in the VC environment. I would not listen to what you're hearing in the general news. I would know your business and see how your comps are doing relative to everyone else.
A lot of good perspectives there. And yeah, it's, you call out something I think is interesting. I think, if you ever want to pay attention to the last earnings for the last cycle, at least for software, it looked like it was overall pretty good. I think Q3 is going to be, the biggest market signal that we can kind of look at and see how people are shaping up demand on a lot of these bigger companies. I personally like to see the hiring environment. How is that? What's the pulse around that? And when are people more hiring versus blowing up their orgs? Taking us to the next topic, and I think this is one that a lot of people have a lot of questions around. Captive AQ, we know in particular that a rep's comp plan is structured. How a rep plan is structured and communicates one of the biggest drivers for how they perform throughout the month, quarter, year. With 2H just a week or two away, at least on the calendar side, how is your team's thinking about changes, if anything, necessary to today's economy and keeping people motivated? Maybe I'll pick on someone in particular. Jeff, I know you've typically gone last when we've gone around the horn, but I know you have a lot of perspectives on this topic. Love to hear a little bit more from what your feedback is on this.
Yeah, so comp plans are a byproduct of the plan of the business, right? So I mentioned earlier tightening up the operations. So if a business is considering an H2 replan, and you think that your target is going to have to be lowered or changed in some material way, that is going to reflect in the capacity that you're going to need on the account executive side of the house, and then your go-to-market sales compensation plans are going to have to follow. And so the annual plans that you might have locked in November, December, and published in January, February to your reps, that might be out the window, just on the grounds that the business objectives changed. And so any comp plan should drive the behavior you're looking for. Charlie Munger would always say, show me an incentive, I'll show you the outcome. And so if your outcomes that you're desiring have changed, fundamentally, those incentives might have to change as well. And so let's say, for example, that your overall target and your AE capacity has changed. You may want to revisit OTEs, you may want to revisit quotas. And then from there, what are the underlying mechanics of your plan? So should you consider tiered plans, paying on $1 versus meeting a cliff? What sort of other awards and recognition can you provide on a non-remuneration basis to reward your team? Second, you might see a tightening of travel. So reps who have business models that fundamentally sell outside instead of inside. That once again, post-COVID, we were just starting to travel again, but now you're seeing potentially some companies tighten up their T&E. So readjust accordingly based on the new outcomes of the business, and then design your plans to hit the objectives that you're looking for. So I have a strong belief that most startups are re-examining what that replan is going to look like.
I think a good idea there. Go ahead, Christian. Go ahead.
I was going to say, just first point, I think is really important, and it's something that Mark, you and I have always been aligned on ever since we started hiring for the sales org here. Is that what Jeff talked about is the alignment between the business plan and comp plans. And I think everyone needs to be really careful in this type of environment where, rightfully so, you'll see a lot of finance teams kind of clamping down, reining in spend, that kind of stuff. And there can be a pull to use this as a time to basically squeeze dollars out of your go-to-market org by saying, we're adjusting the company number down and really basically redoing a budget or plan or whatever. But for the CRO, for the RVPs, for everybody that's tied to that global number, we're going to leave them on the original number. And I think what that does is create that big misalignment that in a time where it's more important than ever that you retain kind of high performers and the leaders on your team, creates this kind of distrust. And even just over the last 2 weeks, I've had a couple of those conversations with high performing sales leaders where they're in that situation where they're stuck on the old number, and it puts them in a really bad position. So I think where it does make sense to rein in and make changes to plans is on the kind of the rep benefit side. If you've got a new number, you adjust that, whether that's the individual quotas on the team, or if you've adjusted the hiring plan, adjusting the kind of the roll up and global numbers that your leaders and overlay folks are tied to. On the other side, I think where companies will frankly need to adjust is in this era of exuberance the last couple of years. I've seen a lot of companies get really over their skis with super inefficient comp plans, right? Because everyone's just been growing. Nobody cared about things like payback and margin and all that. And where a good kind of rule of thumb for your quoted OTE multiple is 4 to 5x. There's been companies with 2.5 to 3x, crazy high base rates and all sorts of accelerators and stuff. And at that point, in a new environment where companies need to be efficient and need to one day dream of actually being cash flow positive, you can't run a team like that anymore. If you need those incentives to run a business, you've got something broken. So I think there will be situations where there needs to be correction on comp plans, but it's because the original plan was never the right one from a kind of a fundamental economics standpoint. But going back to Jeff's point, if you're changing kind of high level numbers and expectations of the business, don't try and cut corners and screw your sales team. You've got to make sure that you're maintaining that alignment and your culture going into a potential downturn.
Yeah, that's it. You guys both brought out some really, really important key points. And I see Jeff +1 in the chat around the culture and alignment. I think everyone here can appreciate, rewarding your stars, keeping your stars, but also you got to keep a culture that's sound. Otherwise, you're gonna have a bigger issue than missing numbers. You're gonna have people leaving the org. I'd love to be able to touch on some of that as well, on how you guys are thinking about culture and relating to comp plans. But something that Jeff mentioned, I want to go back to. Jeff and Christian, you both mentioned, thinking about OTEs, revisiting quotas. In this environment, I think probably, I imagine a lot of the audience would be curious how you guys think about it. I know a trend that we saw at Captivate IQ over the last couple of years, as the talent market heated up, as more and more companies got funded, bluntly put, quota OTE multiples went down to, below levels that I think we've historically seen. Case in point, I actually spoke to a company recently, and they had a quota OTE multiple for one of their segmentations for around 1.5x, which is probably the lowest I've ever seen for a company. I'm curious how you guys would think about, if you are one of those companies, maybe you are that company that had a 1.5x quota OTE multiple, and you're realizing, hey, that might not be very cool in this environment. How would you start to adjust that? Competition is just super sensitive for people, especially for sales reps. They feel like they had an SLA, and it feels like there's a quote unquote breaking of the SLA, but we know that's not good for the business long term. And it might be water on the bridge, but curious if anyone has any thoughts on how they could tackle getting efficiency numbers to maybe more in line, so that the business is, can still run effectively.
I mean, I think if you're in the hole that badly and you've got a 1.5x or even 2.5x quota OT multiple, again, either you've got really high gross margin, you can just have a crazy structure like that because you can basically pour money into sales and you've got this flywheel going, or you're in that growth at all costs mindset over the last couple of years, and right now I think your business is just broken. I think that the fix is probably have far too many salespeople. If somebody can only return, 2x their OTE, you're probably just not in a situation where you've got the TAM and the pipeline engine to feed them. And frankly, you probably have to right size the team at that point. and just make sure that you're balancing the number of mouths to feed with the pipe that you're getting to them. I think the reality is it's probably going to lead to some tough conversations. But at the end of the day, no rep with that type of multiple is going to be set up for long-term success, especially in this environment. The business is going to break it at some point. And I think if I was to put my investor hat on right now, there's just no way I'd be writing a check to a company that's got those types of economics. So I think it's something that you've got to fix, and you can do it the right way, where the people that are on the team following the fix are actually in a good place, where they definitely are going to have a higher quota, but likely a bigger territory and a better pipe to go attain that quota.
Yeah, I would say OTEs multipliers were always hard in any environment, right? It's like the Goldilocks effect. It's like too hot, too cold, just right. So, act accordingly, figure out, based on the segment you're selling into, the brand recognition behind you, whether you're trying to retain or attract talent. You can use the multiplier as a tool for any number of different approaches to your strategy, but it's always difficult, right? 1.5x is not sustainable in the long run. It could be used as a short-term solution to retain talent, pay a high commission for every dollar sold. But it's not sustainable over the long term. Usually you're right sized to anywhere between 2 to 6x, depending on your segment and what market you're selling into.
Yeah, a lot of great ideas. And I think if you are one of those companies that have, very depressed quota OTE multiples, kind of bridging 2 points that I think we heard from Christian and Jeff in particular today is you still, if the company numbers are coming down or adjusting, and at the same time, you might have quota OTE multiple, you might not be able to continue going further down. So I think there's almost like this honest conversation that needs to be happening across the board about, hey, what does this business need to do to get to where we need to be? And how do we navigate through a storm that's coming? And I think the quicker you can have that conversation, the easier it is to, as a team, navigate the harder conversations and get them out of the way. The more it's prolonged or it's staggered, the more you're just going to be beating your head against a wall trying to get out of this. And, it's not going to be probably a very pleasant conversation in the end. Maybe, turn it over to some of the rest of the speaker group, on this, going back to this original question around how are you all thinking about your plans and structures around this environment? I'm curious how Chris and Rome, how you guys are thinking about it in particular. Chris, I think you had mentioned, maybe starting with you mentioned you're now part of the Microsoft mothership. I'm not sure if they've given you more autonomy in terms of being able to run plans still independently from how Microsoft would want to run it, but curious to see how you're seeing things or adjusting things. And then Rome, would love to hear from you as well.
Yeah, I'll definitely answer the question from the kind of the startup ecosystem. That's typically where I mentor companies in the space, and I think it's more relevant. I think that the typical guidance founders, CEOs are getting right now, in terms of the metrics that are really important to be focusing on, growth, gross margins, net dollar retention, CAC payback, burn multiple, and these are sort of the 5 core areas that founders and companies are really looking to resolve. Really with guidance to have, if they can extend their runway for up to 3 years, that's ideal. So when you look at growth or gross margin or net dollar retention, I think there's some potential recommendations for ways to emphasize those numbers and enhance them. So growth, for example, if 2 to 3x year over year is kind of the general area you want to be in. Our teams being compensated directly for ARR that's being contributed. For example, some SDRs might be compensated on pipeline creation or meetings set. That doesn't make as much sense, right? So can you really attribute right to ROI? Growth to the right customer segment, if possible, enterprise. And I'm not recommending that if you serve startups or SMBs to jump to enterprise, because that will sink you as well. But certainly being conscientious of enterprise customers being more stable during this time, and specifically, organizations that are in certain segments that have more, value-based companies, essentially. In terms of margins, if you have more profitable product lines, sell these. If there are multiple product deals or attached deals that create more stickiness, that's also worth incentivizing in your comp plan. I think net dollar retention is a big one just for expansion. This can be incredibly efficient, more profitable, and if you can shift quotas to include a net new and an expansion quota, or incentivize the expansion side, that's something that we did in my at Ally. Every AE on my team had a net new and expansion quota. Another way to improve expansion is just to focus on strong commitments for expansion pre-sale. So before you land that 500 seat deal, you're already setting milestones and ideally even contractual obligations to expand to 1,000, 1,500, 2,500. What does that look like? And how can you work with the customer to keep them accountable to those expansion plans? And can you build them into the contracts? Also, like, expansion is good when it happens within 90 to 120 days. Like, it's not I don't typically guide sales teams to expand at the time of renewal. Like, that's good, but if you can build a motion that you expand within 120 days, like, that's better. And so that land and expand motion is key. Those are some notes I had, but essentially, like, burn multiple, I think the guidance CEOs are really getting is if your burn multiple is really a measure of how much is your total company burning in a quarter, and then what's your net new ARR in that quarter, right? And so if your burn multiple is 1, that means your whole burn is equivalent to the amount of new ARR. And if it's over 1, CEOs are receiving guidance to reduce and tighten the belt to get it to 1. So I think being proactive with your leadership, I heard Jeff, you talk about just being ultra transparent and over communicative with leadership about these metrics and how you're going to get there. And then in terms of downstream communications to your team, I believe in transparency and directness. Even if you don't have the plan, Mark, talking about it, referencing where we are in terms of the global economy, waters that haven't been treaded yet, and just getting the conversation started, because there might be tough conversations, to your point, Christian, that are to come if reps aren't supporting some of those metrics I mentioned.
Sure. And how about you, Ram? How are you thinking about, or how if anything, are you making changes to comp plans at your company?
Yeah, so I think Chris nailed it right near the end, where he talked about having transparency with your salespeople. Look, salespeople have very long memories. If you took care of them in the past, they know you'll take care of them now, and that gives you a longer leash to figure this out. With that being said, we put automatic shock absorbers in place. So at my last company, Digital Mortgages, what we did was we looked at the Mortgage Bankers Association's mortgage forecast, and we set top down, right? We communicate with our board, we're going for X% of market share. So if that forecast went down, guess what? All of our salespeople's quotas also went down. They still have that in place today. And so while a lot of companies like Blend are laying people off, that company's doing just fine. At this company, at DataJoy, we mostly plug into CRMs. Predominantly, that's what we're doing today. Salesforce is publicly traded, and they share every quarter what their sales and service cloud numbers are and what their forecasts are. So when we see that go down, that's reflected in our salespeople's comp plans. So I think there's some ways you can automatically set that, so it gives you a head start, so you're not fighting on your back foot. And then from there, looking at it at a situational basis, right? What is needed in terms of spiffs, changing the comp plan in general, because at the end of the day, your salespeople are being recruited right now. I can tell you that for a fact. People are hiring again. Snowflake, when they had their last earnings report, they showed that they are increasing the number of salespeople they're hiring. So there are companies that are doing well right now that are printing cash flow. And if your salespeople are doubtful about whether or not they're there and they're good, someone else will be taking them.
A lot of great ideas. One thing I was just listening between Chris and Rome that I think it's important to underscore. There's a lot of different levers to pull for a comp plan. And I think you heard, especially from Chris, kind of outlining different scenarios or different metrics and different ways to apply these levers. So I think the one thing that probably needs to happen is just from a leadership perspective or a leadership team perspective, what is the company focusing on over the next several objectives in this environment? Getting that, that sense of clarity. And then you have a lot of the ideas about what levers to kind of operate or to adjust your comp plan against to solve against those drivers. Going back to a conversation that we had a couple minutes ago around adjusting comp plans, whether it's quotas or OTEs, et cetera. There's been a question around, relating to everyone's feedback here around how long this will last, 12 months, longer. I think some people on this conversation or in this call in the audience might wonder, should I be given some temporary relief, given that it's kind of a wait and see if things get better in the tail end of the year, or should I just go ahead and making wholesale changes, knowing the implication that that's kind of setting the watermark for the next however long? Anyone have a perspective of whether you recommend doing anything temporary or just go ahead and jump right in and adjust things, knowing that, that might be what you have to kind of align yourselves to for at least a little bit longer of a period?
I think if it's a reaction to like we were talking about before, changing kind of company plan, especially for the next several years, your long range plans, then that's where it's okay to make a kind of, you're referencing, Mark, commit to a longer term shift in mentality for the comp plan, whether it's better or worse, whatever. But if there's situations where you're seeing, say for example, you have one segment that's hit particularly hard by a gap in pipeline generation coming from your outbound team or marketing, or one team gets, they're in a segment where they're missing a feature and that's hitting them really hard, but we're going to have that feature in 3 months, whatever. In those situations, I think that's where you can do something that's temporary and position as temporary up front. Hey, this is what we did during COVID. When everybody saw a big hit in Q2, we made an adjustment with kind of an end date on it, and then reevaluated at that end date whether or not we were going to extend it. I think people appreciate that and appreciate that transparency. When it comes to the former, though, if you're making a change in reaction to broad market shifts, that's where I think you can position something as a longer term adjustment. And I always encourage our customers to, if you're going to make a change like that, do it for a new year or at least at the half year. So it's not something that's like kind of out of nowhere in the middle of a quarter that can get messy and lead to some weird behavior stuff. And even when making those longer term changes, I think it's fine to position as, hey, we're making this change because this is what we're expecting to see from the market and the fundraising environment for the next, year, 2 years, 3 years, whatever. We'll reevaluate this on a consistent basis like we always do. And it's, subject to change. But I think you shouldn't necessarily shy away, especially in this environment, shouldn't shy away from committing to a long-term change, just because given all the signals that we have.
A lot of great ideas there. I think I heard in particular, if I kind of stitch together one thing I heard just as a theme from all of you, culture preservation is pretty important. And I think a lot of companies are going to be faced with hard decision around how we make sure we're operating the business we have in front of us while balancing precedence, while balancing trust with the sales org. And I think as go-to-market leaders, that former is probably very, very, the most important, generally speaking, while still trying to balance what's right for the business. But Christian, I think you hit it spot on when it comes to this stuff. I think hopefully for the most part, everyone's hired, people who are good-hearted. They understand the logic train behind this stuff. They understand we're going into collectively a systemic, it's more of a systemic issue. And that level of transparency, that level of conversation, that level of like, hey, here is what we're trying to do, I think goes a long way of building that understanding and continuing that level of trust that, hey, we might need to make some harder decisions, but it's for the long-term good for all of us. I think the more that's done out in the open, I think people start to buy in and subscribe to, what leadership and the broader teams need to be operating against to, weather the storm. I know we're coming up on time, 10:46. I promised we'd have some Q&A around this. So I'd love to be able to open up to discussion from questions that we see in the chat. There is one question I wanted to sneak in really quickly. In the beginning of COVID, just really quickly around the horn, or if anyone has a strong opinion around this, one type of comp plan that we saw at Captivate IQ from our customers was switching to hold and release plans. Cash, basically you'd pay out and cash receive. I'm curious if I didn't hear that today, and I'm curious if there's any strong perspectives on whether people like that plan or don't like that plan, and if that's something that is they would recommend.
Given you got a lot of you got 3 VPs of sales here, I think we're all going to say we don't like that plan. But I'll say it depends on the type of business. Situationally in certain environments, if you need to move to a cash, basically paying on cash receipt, it can make sense if you're doing it from a cash conservation standpoint. But it's generally something you want to do in a short term, and you're doing it because of you need to buoy cash before you get to your next round or something. But I'd say outside of certain environments, or especially in certain environments like this, it makes sense for smaller transactional businesses selling to SMBs, especially if you sell to a SaaS company, you're probably going to get paid. You can feel good that you're going to get paid at some point. No startup's going to generally screw you on payment. But if you're selling to mom and pop businesses, kind of those, call it non-tech SMBs, those are situations like we've got a customer that sells to restaurants. They have to pay on cash receipt because they've got like a 20% non-payment rate on their customers. So it's even the reps actually appreciate it because they don't have to deal with all this messy clawback activity all the time, tracking who's paid and who hasn't. They just know that they're getting credit once the cash actually comes in.
Yeah, I think Christian's nailed it with both of these. I think it's a function of how long is your sales cycle and what is the average transaction size. The longer those are, the more uncertainty there is. And if you're not adjusting comp plans and you're having the comp plan with cash on receipt, there's more uncertainty and it's more likely those salespeople will leave. And unfortunately, if you have a high transaction size and a large sales cycle, those are generally the hardest reps to find. Those are generally strat or enterprise AEs. So it'll be really, really tough to replace them. So I'd be mindful of that for each of your businesses when you're making those decisions.
I would just comment that cash is king in an environment like this for several companies who don't have strong operating cash flows to lean back on, right? Particularly for companies that have been looking to fundraise in the next 12 to 18 months. It's probably more amenable to consider a plan like that. Personally, I'm not a big fan. I personally believe in paying on booking on $1, but everyone should come to the table with intellectual honesty and have a conversation on what makes sense for the business. Consider all corners, and then figure out which modus operandi to operate by.
A lot of great, excellent points. I see a question from the chat. Looks like it's getting a lot of upvotes. To the group, what metrics are you looking at to understand how much you should be adjusting quota? Anyone in particular?
All right, I'll jump in.
Go for it.
So I'm assuming this is tied to the rep level, but I'll try and kind of answer for everybody. So we talked a little earlier about if company plan changes, then you should change the numbers that are tied to it. For your roll-up folks, for leaders of a team that are on a global number, or overlay folks, whatever, that number has a hiring plan generally baked into it. So that hiring plan changes, then that's where their number should then change, right? Going kind of down through the levels on the team. If you have a manager that was supposed to hire another couple of AEs and now they're not going to, then that's where again their number should change. On the rep level, that's where if you have the expectation that they're going to convert at a lower rate because of something outside of their control, or they are going to receive less pipeline because of some business change or something like that, that's where it can make sense to make a quota adjustment. Generally, that's something that is going to be tied to the expected productivity of a rep. It is also something that's for fast-growing companies, everyone tries to get it right. It's a difficult balance between making sure the number's not too high, but also not too low. And that's where that kind of quoted OT multiple as kind of a quick rule of thumb can be really helpful. But it always is going to come back to what is achievable for, X% of your team. to get to their number, and that's generally going to come back to pipeline, assuming you've got pretty consistent conversion across the team.
Good thoughts there. Next question: what are some of the leading indicators to measure the success of your comp plan during a downturn? Jeff, Chris, or Ram, any particular thoughts around that one?
That's a tricky question. I'm just giving it some thought.
I think the easy one is like looking at, as it relates to quota, what's your average attainment? You've got to look at like a large time scale. Generally, if your sales cycle is 3-4 months, then you're going to need a year to get good data on that. And then you always want to be looking at cost of sale. If, let's say, 70% of the new ACV or new ARR you're selling is going straight to commission payments, your comp plan is definitely too lucrative. At the same time, if it's 12%, that's probably too cheap, considering all the different people that are getting paid between AE, managers, directors, SEs, channel, all that kind of stuff. It should be generally somewhere, depending on the type of business, somewhere in the 20 to 35% range. We also want to be looking at the trend. If it spikes in 1 month or 1 quarter, is it because you did a quota haircut and the team leveraged it as a time to really blow it out of the water? That's awesome. Or is it because there's some greater trend or somebody exposed a loophole in your comp plan or something like that?
I think there's a lot of, just to add on to what you said, like, leading indicators is actually a tough one because you're trying to find like the best leading signals. So, I think about prioritizing what those could look like. A thing that I heard throughout the conversation today is actually just having a conversation with the sales team. Now, if you have a big enough sales team, you're going to get a lot of data points around that. And that's probably the best leading indicator. Like, are people trending the right way? Are you hitting, are the objectives that you laid out with this comp plan, are you seeing signs of life is how I kind of put it. I think those are probably the best things to look for. Then you're going to start to also look for the governors, like, are unit economics, are they still in line? Are the industry attainments, as Christian mentioned, are you seeing the success and progress around that relative to the environment? I think that the tricky part about what we're seeing in this new environment and what makes recessions always tough is that people look at historical benchmarks and feel like, oh, like this is what it should be like in good times. And they misdirect around what that could look like in a weird time like this. So I think there's a little bit of like empathy around, like, some forgiveness around what that could look like during a lot of changes, a lot of broader turbulence. But no doubt, I agree with a lot of the points you had mentioned. Maybe last question, and then I'll be able to turn it back to Aaron for closing remarks. Doesn't it make sense to add recession-proof companies as clients to recession-proof your own company's cash flow? I think some of the more complex problems have to have more non-complex solutions.
Yeah, I think if you can. Oh, go ahead, Rome.
I think we're about to say the same thing. I think if you know which the companies those are, by all means, go for it. I think a lot of people thought that cigarettes were recession-proof about 2 months ago. And then the FDA said that they're banning all Juul sales and they're limiting nicotine in cigarettes. And you look at Altria or Philip Morris, they're getting crushed right now. Energy as well. Everyone was thinking, oh, with this inflation trade, energy will rip, and they've just been pulverized the last 2 weeks. So I completely agree with you in principle. I also believe businesses change really quickly, and it's really, really tough knowing what those recession-proof companies truly will be. But Chris, I'll let you take it from there.
Yeah, similar sentiment, Rome. I think, like, again, I always trying to optimize for the outcomes of the business. Like, if we're not optimizing for what the business is trying to achieve, then what are we all doing every day? So, looking at CAC payback or pipeline efficiency, if we know that's important, we can dial in our funnel to really adequately address and ensure we're most efficient in areas where we win. So where do we have the best win rate? What segments, what verticals? If those happen to be value-based companies, like, that's great. And if we can pivot to experiment, that also makes sense too. Can we work with marketing to support that motion most effectively? If we do, I guess it was Rachel, if we want to focus on more recession-proof companies. I think other folks mentioned shifting to short-term goals instead of longer-term quotas. So during the pandemic, we instituted monthly from quarterly. That frequency of assessment made a big impact, and our CEO appreciated it. And other areas would be maybe getting a little tighter on entry and exit criteria for stages, just for getting tighter on forecasting, specifically by segment and vertical. So those are some other areas that I'd look to optimize.
Yeah, I'd also say that pivoting to new segments is actually harder than you think, right? And it also takes longer, right? Getting the messaging right, figuring out the right play, the right coverage models. I think what might make the most sense is taking a look at what's already working, doubling down, tripling down on those areas, and then trimming in the areas that aren't doing so well. Also being aware of any risk, right? Some of the segments that you think are performing well might actually be more susceptible to the recession unto itself. So where I would focus primarily is, re-examining your ICPs, looking at your customer base, particularly if you're in a renewal-based business, seeing what can you do there, at least from price increases and renewals. That might be some of the safest bookings that you can book for the business as well. So I'd honestly ask if you can find any recession-proof businesses, please point them my way.
There's a lot of great ideas, and maybe to add in just my perspective on, I've been in enough of these VC-backed conversations or talking to our own investors and other investors. I think some thoughts around this. The problem with right now is there's a lot of industries that overhired, and I think that's the more tricky nuance. Who hasn't overhired? Because that's, you could argue with capital gain taken out of the market, there should be expected come downs from across the board. That being said, Jeff, you hit on a lot of good points that I want to just double score or underscore or emphasize. I think you had mentioned around, it's really important to be mindful if you're going into a new industry. It might look easy, recession proof, they're buying, but you might not have a product that's set up for it, or you might not have the right messaging that's set up for it. And so it could be very dubious to go into something like insurance, which typically is recession proof, but it's a very highly regulated industry. They might require you to have a whole set of product features that you just literally cannot do in a short amount of time. And by the time you get there, you might be already through the thick of the recession. I think some other things I've heard, if people are looking for ideas, I've heard segmentation, going into enterprise. Enterprise does typically look to buy in these type of cycles, especially if you're more of an operational improvement. I think we can all say industries to stay away from. The feedback consistently right now is VC-backed companies will probably be slowing down spend as their investors are telling them to slow down. The real estate industry is probably one to stay away from right now, in particular with rising mortgage interest rates. I even saw JP Morgan, a big bank, just blew up their real estate teams. So, outside of that, those are the themes I've heard. I've heard also, biotech and healthcare typically tends to be recession proof, and those are good industries to focus in on. I know we're coming up with time. I want to make sure I pass closing remarks to Aaron. So first, thank you all speakers, Rome, Christian, Chris, and Jeff, for lending your gems of wisdom in these kind of just weird times, to be blunt. I think a lot of great conversations came out of today, and I want to thank each and every one of you for sharing your candid and just for your perspectives and what you're seeing and what you're doing out there. And, again, for the audience, if there are more questions, I think we'll find ways to kind of answer those offline. But Aaron, I want to give it back to you to pass to help out with closing remarks.
Yep. And excuse me while I don't have my camera on, but yes, thank you guys so much today for your time. You are a wealth of knowledge, and thanks for sharing just a little bit of it with everybody here today. And to everybody else, thanks for coming. Thanks for your questions. Thanks for throwing your emojis on the screen. Hope you enjoyed the discussion and came away with some inspiration, or at least maybe a little more calm as you plan for these things in the future. And just because the event's over doesn't mean we can't continue the conversation in Slack. You can connect with these guys there in Slack or in LinkedIn. Also, if you're not a member of our community yet, here is a link to join. We have 5,000 people in there that all of revenue operations. The conversation is rich, engagement's high. We're doing great things in there. So thank you all again and have a great rest of your day.